Good morning again, folks. Appreciate everybody taking time to join us this morning. Got a big crowd actually on today. That's great to have so many people taking time out of their day to join us and increase and further their education on financial products and financial information and how to really get ready for retirement. So today we're going to really dive into a pretty controversial product. It's called an annuity. Most people know the name and have an opinion about what an annuity is and how it works and how it can be used. Most people feel like it's not a good product for them, and that's okay. But today I'm hoping to dispel some of the myths, but also talk about some of the good and the bad points about these products and actually show you how to utilize them if you need to or want to help further your retirement or possibly guarantee your retirement a little bit. So we'll talk a little bit about that. So when we start looking at the product itself, let me kind of get my screen up here again. The main thing, are we on? Okay. So the main thing, I just want to make sure that everybody can see the screen, but when we start talking about annuities in general, I want to kind of do some back history on this first. Why are they even important to have? Because you have to understand where we came from or where we are right now as a country as far as our income planning, as our part of retirement that we need to really focus on is that income plan. So if you look at the history of income planning, this is not our granddad's retirement plan anymore. Back in the day, we used to have generally 3 or 4 different types of guaranteed income that was coming in. And we called it the three-legged stool. You've probably heard me use that term before, where we talked about the three-legged stool, where we had pensions, we had Social Security, we had our own personal savings, and those were the primary sources of income going into retirement. Things have changed a little bit, though, when you start looking at what's happened with the pensions over the years. They've actually started to disappear. Many of you know that your company doesn't offer a pension anymore. Maybe hard to believe, but back in the early 1980s, that's when 401ks first came onto the scene. And the IRS created a code that allowed companies to offer additional retirement benefits, primarily for the higher ranking executives and help them to increase their retirement savings. But I think what happened after that is companies started realizing that it was much more efficient, cheaper for them to maintain a 401k plan than to maintain those expensive pension plans. So, as early as the 2000s, first started happening in 1999 and 2000, as these pension plans started disappearing from some of these major companies. When we went into 2001 and 2, the more companies started dropping it because the market was so difficult. It was harder for them to maintain the cost of these pension plans. So it just started becoming a trend at that point where these companies started changing out of the 401 or the pensions and started looking more towards 401ks. To pile on top of that, some of the challenges that we're having right now with the Social Security system is that we're starting to pay more out in benefits than we're actually receiving. So this was actually something that appeared on your Social Security statement back in 2008, 2009. And I can just read through this. For decades, America has kept a promise of security for its workers and their families. Now, however, the Social Security system is facing serious financial problems, and action is needed soon to make sure that the system will be sound enough for our younger workers. In 2017, we began to pay more benefits than we collected in taxes, and without changes by 2041, the Social Security Trust Fund will be exhausted. There would only be enough to pay about 75 cents on each dollar of scheduled benefits. And that is a problem because we don't really have a solution for it. I mean, it said there on the statement that you got, we need to resolve these issues to make Social Security to continue to provide that foundation for future generations. But the only changes that can be made is they either increase taxes to increase revenue or they reduce benefits. Well, we haven't seen any reduction in benefits over the years. In fact, we keep on getting more benefits. And so that has created a huge problem as far as the deficit and everything else, which is a different topic, but that, in itself has created the problem with Social Security. So now our three-legged stool is really wobbly because we don't have the pensions anymore. We are, struggling with Social Security. My thought is that probably within the next 10 to 15 years, Social Security will be some kind of means tested. So if you've done a good job savings, if you got a pretty good healthy retirement account, you're probably going to be somewhat restricted on your Social Security. In fact, we're already seeing it. If you have to take out required minimum distributions, you're already paying more on Medicare. You're getting less than Social Security, and those things are already starting to happen. So the personal savings is our only source of income. And that's what we really have to figure out. How do we divvy that out over the next, 30 plus years? That's where we come up with this annuity. So I wanted to talk about the annuity. There's a lot of information out there about these products. A lot of people will come in and first thing they say out of the gate is that they don't want an annuity. And that's fine. You can do this without an annuity. There are a lot of advisors that's all they do is sell annuities. And that's the challenge that you guys have, is really picking an advisory team that is willing to work with you without this type of product if that's what you want. But there are some benefits to having this type of product in your arsenal, because it does give you some benefits and some guarantees, which we'll go through here in just a second. So first of all, let's find out what an annuity is. Well, I've got a little bit of a warning for you. If you Google annuity, you're going to get all kinds of strange hits. I mean, you're going to get people saying, don't buy them. They're bad for you, or they're great for you. You'll get on a list and you start getting these random emails about annuities all the time and everything. So I just be careful about what you're Googling, but I know that you have to do some research and find out if they are a good product for you or not. I went to Wikipedia just to pull this up, just to give you a definition of what an annuity is. Obviously, there's different types of annuities. There's what's called fixed annuities and variable annuities. Primarily today, we're focused on the fixed annuities and even more specifically, the fixed indexed annuities. So I'll talk more about them. We'll probably do a follow-up webinar on variable annuities and how they work. But basically, if you look at the text here, the annuity is a structured insurance product. Basically, the insurance company is providing the guarantees behind these products. They're using a mortality table to determine how they're going to pay you over the years and what that's going to be paid out as. And if you're using these, you can either set them up as an immediate annuity where you put money into it and immediately start getting a payment out of it next month, or you can defer that payment until sometime in the future. Maybe it's 5 years down the road, 10 years down the road, or it could be just you're deferring the taxes on it. You never want to take that money out and you're creating a bucket for your kids or grandkids or something like that. But the annuities are specifically a insurance product. It's not a life insurance plan. It's an insurance product that is written by many different insurance companies. And then you just have to make sure that the ones that you're selecting have the type of benefits that you're needing in your plan, whether it's income or safety. Which brings me to my next point. There's really, in my opinion, two reasons for these types of annuities, or two reasons to have an annuity in your portfolio. It's either to create safety or it's to create income. Well, as I talked about before, if our pensions are gone and our Social Security is questionable, we may need to create income during our retirement years. Now, if you retired at 67, it's very likely that you could live into your 80s, maybe even your 90s. So we might be retired as long as we actually worked. So we want to make sure that we have income coming in to satisfy our lifestyle. So that may be a point that you need to look at one of these things to create income. Possibly you've got enough money, enough income coming in, but you're just kind of worried about the market and you want to be a little safer. So that's the second reason, is just creating that safety. So let's talk about creating safety first. October 14th through the end of December last year, the stock market fell off about 16%. And most of us are just not accustomed to that type of volatility. I mean, that's the first time in probably 10 years that we had that much of a drop in such a short period of time. And we just recently, may have gotten into the market. I mean, what's happened with low interest rates over the last several years, many people, especially many older Americans, have really kind of been forced out of the safety net of the fixed investments like CDs and savings accounts and money market accounts and those types of things to go more towards risky stocks, because that's the only way they could create any kind of growth or create any kind of income for themselves. So by jumping out of that safety net of those safe investments into the riskier stock investments, and then having a quarter like we did last quarter, that can really devastate somebody's retirement plan. And we certainly want to make sure that we don't do that. This kind of, we've seen this chart before where this is kind of the feelings that we go through, the emotions that we go through as we're looking at the stock market. And as you can see on the graph that, as the market starts to increase and get higher, you get more excitement, you start to feel thrills and start to feel a little euphoria about that. But then as the market starts to turn and go down the other way, it creates anxiety and fear and desperation. And eventually down towards the bottom, that's when you might say, well, I'm just getting out of the market. This is not for me. I'm going to jump out here at the bottom. Many people over the years I've talked to have said, that every time they get into the market goes down. Every time they get out of the market goes up. Well, this is what they're talking about, because the market does seem to pull those types of feelings out of you. And it's hard to manage that, especially when you're emotionally tied to your investment, which all of us are. We're emotionally tied to it. Now, this is an example of how a fixed indexed annuity works. So what a fixed indexed annuity does is it actually ties your returns to a popular index. It might be the S&P 500, it might be the Dow Jones, might be a bond strategy. So there's all different types of indices that they can work with. This is actually from one of our companies that we work with, American Equity. This is one of their charts. But it shows you that if you look at the, let's see if I can grab my pointer here. Hang on a second. Yep. One second. Oh, that didn't work. So I'll just have to do it without the pointer, but as you look at the line that goes all the way down to 63,000, that's actually the stock market. So if you were investing in the stock market, that's how your portfolio could react to a market in the end of 2018, where the market dropped off, significantly, 16%. If you had your money in an indexed annuity, basically what happens is your worst case scenario is you go a year without making any money, but you don't lose any money. So again, the worst case scenario is maybe you go a year at zero returns, but then in the next year, you're going to get some of the upside potential. So as this chart shows, that you could be in the stock market and have all the volatility, and eventually, if you're in long enough, you're going to probably outperform, or you would outperform the annuities based on historic numbers. However, as you get older, maybe it's proper or maybe it's good for you to take part of your money and secure it in something like this, where you don't have that type of volatility and you're not losing ground every time the market decides to have some fluctuations. Some of the strategies inside these annuities, they have many different strategies, but the three most popular strategies is what's called a cap strategy, a participation rate strategy, and a spread strategy. Essentially what this cap strategy does is it caps out how much you can make each year. So if it has a 5% cap and you put 100% of your money in that cap strategy for the year, then you're going to have, the most you can make is 5%. So if the market goes up 10%, basically the insurance company's keeping 5%, you're keeping 5%. The participation rate strategy, this is actually becoming more popular as interest rates start to go up a little bit. Most of the companies are starting to use like a 45, 50, 60% participation rate, which means that if you put 100% of your money in that strategy each year, then you're going to get that percentage of the underlying index. So if the index went up 10% and you had a 60% participation rate, then you're going to get 6% of that 10. But if it went up 20%, you're going to get 60% of that. So it's going to give you a little bit higher upside potential. And then the spread strategies are usually the most, the most lucrative, because you're going to pay a straight fee. So like if there's a spread fee of 1% or 1.5%, then the market goes up 10, you're going to make 9.5, or I'm sorry, 8.5. So if the market goes up 20, then you're going to make 18.5. So they're just taking the first percentage, whether that's like I said, 1%, 1.5, 2%, whatever that spread fee is, that's what they're taking out of your gain. Now, if the market only goes up 1.5% and you have a 1.5% spread, they're going to still grab that. But if the market doesn't go up, you're not paying that fee. So that's nice too, is that you're not paying a fee if it doesn't perform. So again, and these strategies can be changed every year. So it's not something that you got to pick one and stay in it all the time. If you've got one of these products, one of the things that you need to be insisting upon your advisor helping you with is helping to manage those strategies, because every year you can change these strategies. We get people in here all the time from either our webinars or our workshops or something like that that have had one of these products and they haven't talked to their advisor in 7 or 8 years. And I think that that's a crime. The advisor gets paid a commission when they set these things up, and they never get paid any more on it. So it's not like they're getting paid all the time. So you have to really go back and get your advisor. They should be managing that for you or helping you manage it, because they did get paid on it on the front end of it. Many times when we bring in new clients, if they've got one of these products in their portfolio, we'll just assign it to us. Again, there's no compensation for us, but we just help them manage that portfolio, because it is a product that you do need to kind of tweak and work with every year. So there's different types of these annuities. And like I said, the fixed indexed annuity is one of it's going to give you some market participation, but you're not going to suffer the losses. So when you start looking at these types of products, you got to know that you're not going to get rich off of these types of products. These are designed to be more of a kind of like a bond replacement is what we've been using them for here recently, because the bond interest rates have been so low. They've given our clients an opportunity to participate in some gains, but not suffer the losses. But I think on average, I always tell people, and this has been from past personal experience, is that these products are typically going to average somewhere between 4 to 6%. They're not going to be, lighting the sky on fire most of the time. You might have a year every once in a while you get double digits, but the next time the market drops off, you're going to get a 0 return. So on average, again, that 4 to 6% seems to be pretty common between all of these types of products that are out there. And they, pretty consistent with that as well. So if you're looking to have something protected, that might be a way to do that. As far as a pension replacement, the one reason that I've talked about is creating income. So maybe it's where you take a portion of your retirement savings and you carve it off of your big chunk of money, and you say, okay, I'm going to use 30% of my money to create income. And I need to create a certain amount. So in the calculation, the way we would do this is you would actually start to figure out how much you need to fill that gap. I'll talk about that here in a second. Most of these products actually have an income rider. These income riders really became popular in about 2003 or 2004. Normally, the fee for these riders is somewhere between 0.5% and 1.5% per year. So they take that out of your account value. But typically what that's going to do is it's going to give you a stated rate of return for the income value. And that way you kind of got some guarantees going forward as to how the income is going to look when you need that in the future. Also, make sure that you understand that these riders are things that you add on at the time of issue. It's not something that you can add on to your plan later, but then you can elect how to use these riders in the future as far as creating that income. There is after our meeting today, I'm going to send out, or actually Taylor's going to send out an email that if you want a link on how to bridge the gap in retirement, this Bridging the Retirement Gap white paper is available. So we'll send a link to that as well. So how do these income riders work? The income account value, the IAV, is usually a stated percentage. So if you buy one of these income riders on your annuity, let's say you're paying 1% or somewhere around that 1% fee, then what it's going to do is typically give you a stated rate of return for that income value. So in this case, what is in my example here, let's say that the annuity that you bought has an 8% roll up for the first 10 years. That means regardless of whatever the stock market does or whatever the account value does, the income account value is increasing by 8% each year that you own the account over that first 10-year period. So in my example, if you had $100,000 and you invested that in an annuity and it had an 8% roll-up factor in 10 years, contractually, the income value would be $215,892. Now, if you decide to turn on your income in year 10, then that's what they're going to base your income on, that $215,892. So regardless of what your account value is, they're going to base it on that higher number. Now, if your account value happens to outpace that or grow higher than the 215,000, then they'll use that number. But it gives you the certainty that you can look at 5 years, 10 years, 15 years in the future and say, okay, if I need so much money to keep up with inflation, then I can turn on this annuity at that point. It's going to be based on a certain number. Some of the income account values are based on a calculation. So it may not be a stated percentage. Maybe it's just some kind of calculation in the contract. I know there's one of them that does 200% of whatever the account value grows at. So if your account value grows at 3%, then the income account value grows at 6%. And that continues on until you turn on that benefit. So that's many different ways to calculate that, but there are those nice income benefits that you can actually have. One word of caution that I want to make sure everybody hears is that a lot of advisors are using these annuity benefit income values to sell them as the guaranteed rate of return of the product. For instance, you might have talked to an advisor that says, hey, we've got one of these annuities that's paying an 8% guarantee. And then you may come in and talk to us and we'll say, well, no, it's not necessarily an 8% guarantee. That's an 8% roll up on the income value. Two different things. So make sure that you don't get caught in some kind of a situation where an advisor has told you that you're going to make 8% guaranteed. It's probably going to relate to some kind of an income payment, not the actual return of the account value. And that's, again, like I said, very, very different calculations there. So the income account value is going to grow at a stated rate, but the account value is going to grow at whatever the market performs at based on the index itself. So here's some of the steps that we would say are the next steps that you would take as far as considering whether this is a product that you need. Do some income planning. Start looking at your Social Securities. If you got a pension still, what are those guaranteed sources of income that you have? Maybe you got some real income that's coming in. That's not really guaranteed, but it's pretty certain. But look at that income that you got coming into your household. Then determine really what your expenses are. This is an area where a lot of people kind of fudge on. They'll come in and they'll say, well, we spend $2,000 a month, but then they didn't calculate their taxes and insurance that they pay once a year and stuff like that, or their vacations. We want to make sure that you take all of those expenses, your monthly bills, everything that are fixed expenses, and your annual expenses, add them all together, then add in those discretionary expenses when you take vacations, eating out, helping the kids, doing all that, and then determine if there is a gap in there. Is there a gap of $500 a month or $1,000 a month that you need to fill? If you do, an annuity might be a good tool for you to use to do that with, because you can guarantee that you're going to have that gap filled. Then you build your investment strategy based on that. I think if you have guaranteed income, it's a lot easier to withstand the stock market gyrations like we've seen in the fall of 2018, because now you've got that income coming in and you're not relying on taking income out of your portfolio. You still might build an income generating portfolio using some dividends and everything, but you don't have to rely on it, especially when the market's dropping off at 10 or 15% in a quarter. Make sure you do your tax planning. Taxes are going to be a huge problem in the future, I feel like. So you want to make sure you're doing your tax planning. We've done many different workshops this past year and still continuing to do them to help you guys understand how to, convert accounts, Roth IRA or regular IRAs to Roth IRAs and things like that. And then also make sure that you have an estate plan. Remember, if you don't create an estate plan in your state, then the state that you live in is probably going to create one. Like here in Kentucky, if you don't have one, Kentucky has one for you. So you don't want to get caught up in their planning and allow them to, decide where your money goes and all of that. So hang on a second. Trying to get video started again. Okay. So the video's still on. So anyway, the point is make sure you have all of these things as part of your planning. Determine whether that income gap is real. If you don't have an income gap, maybe you need some of this money in some kind of a safe investment. This might be a tool that you could use. One of the things that we have coming up here in a short time is actually some of the upcoming events. We actually have an event coming up at the U of L Shelby campus, March 11th and 18th. This is a Retirement Today workshop. It's actually a two-part series, so you're coming 2 nights, 11th and the 18th. Starts at 6 p.m. And you'll actually sit down in the class. We'll have an instructor there that's kind of going through all of the different types of things that you need to look at as far as retirement planning. You can register there at that website, and you'll get a link to this in a follow-up email. So if you don't write that down, that's fine. You're going to get a follow-up email that'll show you that. Also, we've got some retirement 360 game plan dinner workshops coming up March 5th and 7th. Again, at 6 p.m. at Ruth Chris Steakhouse. Again, you can go to that website, or you'll receive a link where you can go and log into that and have some, have good dinner on us, but also understand a little bit more about what we do and how we do it here at Mercurio Wealth Advisors. So that's it for today, folks. I really appreciate you signing in and looking to us for more information. We're going to keep these webinars going. If you know somebody that you think this information could be beneficial for, make sure that you pass our information on to them so they can log in. Obviously, there's no obligation to do this. Maybe put a little time involved in it, but you hopefully will get something out of this to actually see what you need to do getting ready for retirement, or if you're already in retirement, maybe what you can do better to stabilize your retirement and make it a good time of life. So hopefully that's been good for you today. If you'd like to give us a call, feel free to give us a ring at our office, 253-9366, or go to our website, mercurioadvisors.com. Thanks again for your time.